Hi everyone, you're watching the Virtual Amicus and I'm Jay Lodha. So today's topic for discussion would be on decoding budget 2022, the hits and the misses. Now, what do we mean by the union budget? According to Article 112 of the Constitution of India, the union budget of a year is also referred to as an annual financial statement, which is a statement of the estimated receipts and expenditure of the government of that very year. Now, union budget keeps the account of government's finances for that very fiscal year, which runs from 1st of April to 31st of March. It can be classified as revenue budget and capital budget. Now, who understands the budget better than two brilliant chartered accountants and two distinguished lawyers? Because lawyers are the best interpreters of law, while nobody understands taxation and budget better than a chartered accountant. So, for the first time on the Virtual Amicus, we have not one or two, but four speakers, two distinguished chartered accountants and two brilliant advocates. And one of them is featuring for the second time. That's right. That is Mr. Daksh Pareek. And just to give you all a brief introduction about our first speaker, Mr. Sachin Veyas. He is a practicing chartered accountant who, for over 8 years now. He's a fellow member of Institute of Chartered Accountants of India and a qualified company secretary. He's also cleared diploma in information system audit and on current audit of banks from the Institute of Chartered Accountants of India. He's also worked with Citibank as a part of their risk team for around 2 years before joining professional practice. He currently handles income tax advisory for corporates and MSMEs and representations of tax matters before income tax officers, commissioners, and income tax appellate tribunal. He has been an all India ranker, which is all India rank 36. That is what he secured in the examination that was held back in 2012, conducted by the Institute of Chartered Accountants of India. He's a recognized speaker over various diverse topics of direct taxes and MSME matters and advises multiple MNCs and listed companies on taxation matters. And today on the Virtual Amicus, he will be dealing with direct taxation and how this budget has impacted and brought in certain amendments and changes to direct taxation. So thank you so much, Mr. Vyas, for taking out time from your busy schedule and doing this session on direct taxation. And the stage is set. The floor is all yours. Over to you, sir.
Thank you, Jay. Thank you very much for having us. Of course, it's a pleasure to be on your show and be a part of this grand panel to discuss the budget. I'll, of course, be dealing with changes being made as a part of direct taxation. Direct tax, of course, affects all of us. We all are tax-paying individuals, and whatever changes happens in the direct tax regime, which happens annually, is, of course, relevant to each one of us. So I'll be just sharing my screen now, just to have let you all have a glimpse of the PowerPoint presentation. And I'll be just covering a few important topics. Of course, I'll not be going through each item, but whatever is relevant or whatever I felt was relevant to the audience, I have sort of tried to cover that. I hope you can now see my screen. Is my screen visible?
Yes, now it's visible. You
Right.
can enable the full screen mode. Yeah, perfect.
Right. So this is, of course, a very welcome step that has come as a part of this budget. This is a relief given with respect to keeping COVID in mind. COVID, of course, has affected all of us in the last 2 years. And this is one step that has come in order to ensure that there's certain benefits or certain tax benefits that would arise to individuals and people who are affected by COVID. One problem that everybody was facing as a part of COVID was wherever, if you had some person who was ill in your family and you were receiving money from multiple people or people who were trying to help out, whether it's in a society or whether in friends and family, there were a lot of taxation issues that were arising out of it. The budget through this amendment has tried to resolve a few issues. One thing, for example, they have tried to do is that in case there's a death of any person, any amount received from the employer on account of death due to COVID or COVID-related ailments would be 100% exempt from tax. That is, of course, a very welcome step. In case you are receiving it from other people, there is a capping of 10 lakh that they have done in order to ensure that this step is this provision is not misused. One good thing that they're doing, they're implementing this section retrospectively from financial year 1920. So even in case, say 1920, you receive some money, 2021, which is the current year, current fiscal that is going on, even if then you are receiving some money, that also will be exempt. and this takes care of both illnesses, money is being received as a part of illness and money received on death. So this section sort of helps out in both items. Another change that they have tried to do is with regards to the annuity payments that one receives from for a disabled dependent. Earlier, what was happening was, in case there is a disabled dependent, any money that was being received while the main person or main parent or guardian was alive was taxable. Now, any annuity, even if they're receiving before the death, that they have tried to ensure that that part also becomes taxable, non-taxable, and that of course is one benefit that is being given to the disabled persons. Other steps that they have tried to otherwise, I think in this budget overall there is, I'll just let everybody know that there's no changes in tax rates as such. There are no tax benefits that have been given to the individuals. I think our honorable finance minister, as a part of her after budget speech, had said that she has not increased tax rates, and that in itself is one benefit that she's giving to the common people and the middle class. While we, of course, take that with a pinch of salt, but that is the harsh reality that we live in. We do not have any tax changes in this year. Only one minor tax benefit and tax relief that we are getting this year is in terms of surcharge rate. Now, what happening was that your long-term capital gains tax, which is taxable under section 112, was the surcharge was capped at 15%. That is arising out of long-term sale of equity shares. Now they have capped all LTCs. So now, if you, in case you sell a property, the surcharge earlier was going even up 25 or 30%. The surcharge is now being capped at 15%. So there's only one benefit that is being arising to all of us as a part of this budget. Otherwise, there's no major tax benefit that is being given to anybody as in terms of tax rate or in terms of other benefits. I'll just move on. So this chart just goes on to show the tax rates for companies. Again, it remains unchanged. There's no change in tax rate. Just one small change that has come in this budget is the MAT, the AMT rate for cooperative society has been brought at par with the companies, which is at 15%. Earlier, that was a little higher. So basically, as a part of this budget, what they've tried doing and what we felt as professionals they tried doing is only just take out small anomalies here and there and make sure things are at par. Otherwise, no major benefits have been given as a part of this budget. This again is, I think, one hot topic that has come in as a part of this budget. It relates to taxation of virtual digital assets. This is basically crypto and all of NFTs, all those items that we've been, of course, hearing about and have been really in the news in these days. They've done 2-3 things here. They've, of course, made profit from sale of virtual digital asset taxable at 30%. That is similar to what you have for lottery and all other similar profession speculative businesses. Another thing that they tried doing is they've tried to define digital currency. That definition of digital currency is pretty exhaustive. They've tried covering everything, and finally they've also left out another item in case something is missed out. They can obviously go back and amend that definition as well. This is to say that it is not as if this sale of crypto is not taxable in the current year. They've just tried to define it as a part of budget which is being applicable from 1st of April 2022. Even today, if you are to sell your digital asset or crypto, it is not as if this income is not taxable. Even today, this income is taxable, whether you take it in the slab rate or whether you'd like to take it as a part of capital gains tax. Of course, everybody and the overall view of the professional community is that today, even if you, because the judgment has come, regardless of the fact that it is not retrospective, ideally, even today, if you have a profit from digital currency, you should be taxing at 30%, because later the AOs can take a view that this should be taxable at 30%. Another small thing that they have included is in this is with regards to TDS. So when you make a payment to any person for sale of digital currency, TDS of 1% will have to be deducted. Now, as we all know, on a crypto exchange, we don't know who the seller or the buyer is. So for me to deduct TDS for the person to whom I'm paying the money for buying that digital currency is of course not possible. So I think this part being applicable from 1st of July will have to be taken care of by the exchanges, say Wazirex or similar exchanges that are there handling these cryptocurrencies. And of course, there will be further rules and items that will be coming in as a part of subsequent rule that will be coming as a part of this TDS section. Another thing which is a matter of debate which is going on in the industry is with regards to whether the government has, by taxing virtual digital asset, legalized virtual digital assets. Well, to my mind and in my personal opinion, I think the answer is no. In no way are they saying that they are legalizing a digital asset. They are just trying to tax it. I think the legalization of a virtual digital asset still has a long way to go, for which I think the central bank and the government has to come on board and ensure that there's a proper mechanism to see that these virtual digital assets have a legal shape. So having said that, I think there's still time for that. But currently, we know for sure that in case you sell a digital asset online or through any exchange, you will be taxed on this income at 30%. Moving on, there again some benefits has been given and some shifting and postponement of dates that have happened as a part of this budget. Of course, we know because of COVID, we were not able. A lot of work could not be completed, or a lot of work is still in work in progress. So because of that, what they have done is they've one 80 IAC clause which they're given for uh, uh, startups, giving them the benefit that out of 10 years, 3 years, they can have tax-free incomes subject to conditions. So earlier, the date for setting up manufacturing and period of incorporation was 31st March 23. That is now being shifted to 31st March 2024. So of course, that's a welcome step. One more year is being allowed to them in order to start the manufacturing process. Certain incentives, as we all know, the government has always been trying to promote the IFSC that they're in Gujarat. So they've tried to come up with certain tax holidays and benefits with regards to IFC and with regards to investment in IFSC. We believe that obviously these are welcome steps in terms of for NRIs to invest in India and have more exposure to the Indian economy. There's certain other key proposals that have happened this year. Now, there's certain amendments which were there in terms of the budget, which were made in order to reverse some legal positions that were taken by the High Courts and the Supreme Courts. One such position is with regards to 43B, which deals with deduction only allowed on actual payment. Earlier, what it was happening was that in case a company was unable to pay its interest payments or honor its interest payments before the filing of return, they were liable to disallow that expenditure with regards to payment of such interest, or such interest expenditure was not allowed. Another unique way what they have thought was they started capitalizing that interest payment. So for example, a company was due to make a payment of 100 rupees of interest. They issued debentures or other forms of securities against that 100 rupees and said that because we have issued new securities, this amount should be treated as paid and hence should be allowed to us. There was some judgments in favor of this as well. But I think the law is now being retrospectively amended to ensure that in case any such interest payments, if are not being made in actual cash or if they're actually not being paid, will not be treated as expenditure and will be treated as expenditure only in the year in which they are actually paid. So again, I think this is moreover a tightening of steps for the tax regime as a whole. Another step is with regards to expenditure which are being disallowed with regards to exempt income. Section 14A deals with expenditure with respect to exempt income should be disallowed. Where obviously we all are aware of that in case you have an income which is exempt, any expenditure with regards to such income will also not be allowed to you. But however, what was happening in the interim was that in certain years where there was for a certain portfolio, you have exempt income, you have taxable income. In case in that specific year, exempt income was not incurring to you, people were allowing that expenditure, saying that because there is no exempt income, we should be allowing that expenditure. That also has been sort of tightened up as a part of this amendment, and it has been clarified that in case there is a certain expenditure which is related to exempt income, whether or not that exempt income has incurred to you or not, that expenditure will not be allowed to you during that financial year. So uh, actual incurrence of exempt income is not a necessary step to disallow that expenditure. One more, I think, and this is specifically to with regards to Sesa Goa judgment it was given by the Bombay High Court with regards to cess. Now there was a judgment that came in which said that cess is not a tax and should ideally be allowed in expenditure. Uh, there was a lot of debate that was going on. I think that has also been settled and settled with effect from financial year 4-5. So anywhere people who have taken the deduction of cess as an expenditure, for example, higher education cess and any other cess being paid as a part of um, your normal practice, uh, those cess will not be allowed in expenditure. Again, there will be a lot of implications for people who have taken benefit and deductions of these expenditures, and it is advised that in case you have taken a deduction of cess in any of your earlier years, ideally you should be paying the amount of tax and interest on that amount. Of course, penalty cannot be invoked in these cases because it's just subjective matters, but it is better to pay and be done with the tax part because this judgment has come in. One concession that has also been removed has been for dividend of foreign companies. Now, for example, if there's an entity in India who's a holding company or is holding some shares of a foreign company and is receiving dividend from such foreign company, earlier that income was taxed at 15%. Now that amount has also been removed. Lastly, I'd like to speak and just spend a few minutes on Section 68 that has been amended from now. Now, this Section 68 is one of the more dangerous sections that we have encountered. Multiple additions have been made with regards to this section, and we have had multiple case laws coming in over the years over this Section 68. Now, Section 68 specifically talks about unexplained credits and unexplained cash credits. So basically, in your balance sheet, if you have any money which you have received or any credits that you have received in your bank, which you are unable to explain, the government will, of course, treat it as unexplained cash credits and will tax it as overall rate of around 70 to 78, 75 to 78%. Now, what they have done now as a part of this amendment is just enhance the scope of this section a little furthermore. Earlier, it was just any amount of loan, any amount of money. They've changed that definition. They have taken any amount that is lying in your balance sheet, which remains unexplained. So that includes your creditors, your any advances that you have received, any loan you have received. That if you are unable to explain or unable to give a confirmation or unable to explain their identity, that amount will be treated as your income and will be taxed in your hands. That is one part. Now, there's another concept of income tax which goes on checking the source of the source. Now, this section tries to invoke that part of income tax wherein now today I've taken money from A. Now, government can check whether from where has A brought in that money. If A has not paid tax on that money, that money can be added in my hands because they will treat that this money has not been illegally generated or this money, this cash credit actually pertains to me. So this is again sort of tightening up the whole atmosphere with regards to Benami transaction, with regards to entries. They have really make this section a little more stringent now, which will affect all of us as we go into any income tax scrutiny or any income tax proceedings. The AO has straight away power to treat these items as unexplained cash credits, and it will of course be very dangerous in our hands. So wherever and however we are receiving money in our books, we should be ensuring that that money is clean money, because and which is a very difficult step to do. Today we don't know where and how the money is coming to us, but because of this section we'll have to ensure that clean money is only flowing to our books, otherwise it could be added in our hands as well. So again, a little dangerous for all of us, and we see how the courts interpret this section and what benefits the courts may or may not give to us. That only time will tell. But this is something to look out for, and one major change that has happened as a part of this budget. Moving on, there's some items with regards to TDS. For example, a provision for benefit of perquisite exceeding 20,000, any perquisite that you may receive is liable to be taxed at 10%. This again related to any benefit that you may be giving to any individual, any commission agent, all of those people, any benefit that you may be passing on to them. Earlier that they were not able to track those. Now they will be able to track with regards to this section of TDS. They've tried to increase the penalty for failure to answer questions, sign statements, furnish information, all of that from rupees 100 per day and rupees 5 to rupees 500 per day. Now, one, I can tell you, in case you miss out filing a return or miss out making any compliance, 100 per day penalty was also a little high, because when you miss a compliance, it's sometimes missed for a good amount of time. When you go back and see the number of days that have elapsed, the penalty runs into thousands and even lakhs sometimes. Increasing that fivefold is, of course, a step that goes on to show how serious this government is with regards to compliance, and how the problem for all tax professionals and for all clients in general is that we need to ensure that compliance is done timely. Otherwise, we could be these penalties could be levied onto us as well. Um, Another step that they've done is that the prosecution provisions for second and subsequent failure to pay tax have been proposed to be extended for TCS. Now, this prosecution earlier was there for TDS, is being now moved for TCS as well. So again, more stress on compliance, more stress on getting things done on time. Otherwise, there's large penalties that will have to be paid. Moving on, some certain changes have been made with regards to carry forward losses in case of divestment of public sector companies. As you know, the government is trying to reduce the stake in public sector companies. So what they have done or tried doing is that in case a new buyer, for example, Air India now gets sold to Tata, they can now, earlier the section was there which did not allow carry forward or losses in case there was shift of ownership of more than 50%. They've tried to remove that only for specifically these public sector companies, so that any new buyer can take the benefit of buying these companies and can carry forward those losses. That is again in the interest of, I think, the government itself, not in the interest of public in general. Another other small changes that are made is with regards to reduction in goodwill. Last year, what they have done was that they have they've removed the provision for allowing depreciation on goodwill. Now they've, in order to in case you have already disallowed over a period of time taking depreciation on that goodwill, and in case your overall asset value is less, it will be now be treated in this year, it will be treated as capital gain. So again, minor changes to already amended sections, minor changes to sections which were already there implemented last year. Changes have also been made in this section for slum sale. They missed out somewhere writing the word transfer instead of sale, so they've amended those as well. These are again small items that they've changed in their interest and whatever feedback they've received from the industry in general. As we all know that the assessments are now being done faceless. We are in a world where we do not have to visit officers, and all the replies have to be filed on the e-proceeding portal of the government. There's a faceless scheme that was introduced last year, for that regard. What they're now proposing to do as a part of this is they're trying to extend that to transfer pricing assessments and the RPSS proceedings as well. So ideally, we'll have a world where all assessments are being conducted as a part of faceless regime itself. Currently, even rate cases or survey cases are being handled through physical proceedings. Of course, subsequently, those will, as we believe, will also be get covered as a part of these faceless proceedings. Here we are trying to talk about TDS and TCS for non-filers. We have, of course, last year seen that in case you have a person who's not filing returns for the last 2 years, you are required to deduct TDS at a higher rate for such individuals. So they've changed the definition of specified person to include, this is more of a clarificatory amendment that they have made, wherein they have provided that a specified person means a person who has not furnished income tax return in the previous year preceding the financial year. So, and the payment of tax or TCS or TDS, whichever is there, is more 50,000 or more. So they've just amended these definitions, not a major change in terms of um, TDS provisions. However, it is just we have to ensure that in case a person, other person to whom we are making a payment is not filing their returns, we have to ensure that we deduct TDS or TCS at a higher rate. Otherwise, that will also fall on us. One minor change that they've made is to deduction of TDS in case of sale of immovable property. Um, as we all know, last year and during the year, there certain provisions, certain sections were introduced in order to allow people to buy and sell properties at lower rate than the stamp duty rate. So currently, we have a situation where you can buy and sell properties at less than 10% less than the stamp value rate. Uh, Ideally, in case you buy a property at value over 50 lakh, you're required to deduct TDS at 1%. Now, what they have minor changes they have done is they've made it higher of consideration for transfer or stamp duty value of property. So, in case you're buying a property which is for 80 lakh, the stamp duty for that property is say 85 lakh, you are required to deduct TDS at 85 and not 80. So, there is one small change in terms of compliance that they've also made this year. Now, one benefit that the government has tried passing on, other two benefits that they've tried passing on is one is with regards to appeals being made by the department. Normally, what happens is they set monetary limits for commissioner appeals, for orders against commissioner appeals to ITAT, and for orders of ITAT to high courts and supreme courts. What the government is proposing as a part of this budget is that in case there are certain matters which are common matters on which the department is already in appeal, they will form a committee, a collegium of two or more CCITs or PCITs or CITs to decide whether that common matter needs to be appealed in case of the SSE. So, for example, you have a certain case, you have a question of law is arising out of your matter. You have, say, one in, say, ITAT, and in an idealistic scenario, before the section, depending on your monetary limits of taxation, the government would ideally be filing an appeal in High Court. Now they will look at this matter. This collegium will look at this matter, see if the similar matter is pending between a jurisdictional High Court or a Supreme Court or the Supreme Court. And in case the question of law is pending, they will not file this appeal till such time this question of law is resolved. So this and so that ideally what this will do is this will reduce the number of appeals, and this will sort of increase the application of mind while filing of appeals. Currently, what we witness is that no application of mind happens in case of filing of appeals. In case they're above monetary limits, all cases which are which the government loses at a lower level, they file appeals against those. So hopefully, we believe that in case this collegium will do application of mind while filing appeals, this will obviously be beneficial for the SEs and reduce the overall number of appeals that we have. Lastly, again, this is one demand that the Institute of Chartered Accountants of India was continuously making, that currently we have a 9-month period to file our income tax returns. Now, this 9-month period is a little short. There are multiple compliance dates that fall between this period as well, and sometimes people miss out filing those returns. So earlier, we could only file our belated return up to, say, 31st December of or 9 months after the financial year. Now, as a part of this amendment through this budget, what they have tried doing is they have tried to involve an updated return, which you can file for 2 years up to the after the end of your assessment year. So now, for example, for financial year 1920, the assessment year is 2021. You can file your this updated return up to the period of March 23. So that way, this one return, this one benefit that they're trying to pass to assessees to correct their own mistakes. But again, this comes with few caveats and a few conditions of their own. One, you can't reduce your income. So in case you have filed your income of at say 20 lakh and now you want to say my income, I miscalculated and I want to reduce it to 15 lakh, you can't do that. Second part is you can't claim a refund as a part of this regime. For example, you've paid a tax of 5 lakh and now you want to say my tax liability was lesser, I want to claim a refund now. Obviously, you can't use it for your own benefit. Thirdly, they will be, of course, charging a little more tax than your overall tax liability than you would have normally paid in case you would have filed this return on time. how much would that excess tax be? You will be required to pay your tax as well as your interest as a part of this return. Add to that, in case you file it up to 1 year from the end of the relevant assessment year, you'll be required to pay 25% additional tax on the aggregate tax and interest that you're liable to pay. Now, and in case you do it in the after 1 year from the end of relevant assessment year, then you have to pay 50% additional tax on your tax plus interest value that remains payable as a part of this return. Now, this we all believe I think is a little harsh and could have been little avoided. Ideally, the government should have promoted people coming ahead and filing their taxes, even because and the government is of course receiving um, tax plus interest, and interest of course 234 ABC. That interest itself is pretty penal in nature, but adding this tax amount and 25% and 50% of aggregate now of tax and interest पे भी आप tax दे रहे हैं. So that it's a little harsh and little against the overall spirit of the act, but I think there's nothing much that we can do about it. Also, there's certain restrictions with regards to the fact that in case you have any Benami transaction, in case you have any transaction, or in case you have proceedings under one section 132 or 132A going on against you, you can't invoke these. So you can't use them to your benefit, or in case you believe you're likely to be caught. Um, for all those cases, this updated return I think will not be beneficial. Only in cases where we believe we have missed out and there's a genuine error on our part and you want to come clean, I think this is one welcome step that we have overall to ensure that we can rectify our mistake and pay the requisite tax and be free from overall tax liability and penalty. So that's all from my side. Over to you, Jay. Thank you so much for having me, and it's been wonderful being on your show. Thank you.
Thank you so much, Mr. Sachin Vyas, there for your valuable insights on this really very important aspect of the budget, direct taxation, the hits and the misses. And it's always nice when a talk is backed by a solid PowerPoint presentation. I think that is what makes all the difference, the impact that it has. So thank you so much for doing this for us and by way of a PowerPoint presentation. And I'm sure our viewers will obviously and immensely benefit from this on direct taxation, where with regard to the procedural amendments that have taken place, how reduction in filing has taken place, the litigation aspects, everything for that matter. Now, we are joined by someone who needs absolutely no introduction in the field of taxation. And he's here and he'll be discussing various legal aspects vis-a-vis direct taxation. So today we are joined by Mr. Javed Khan. And just to give you all a brief introduction about Mr. Javed Khan, he's an advocate by profession. He's practicing before Honorable Rajasthan High Court Jaipur bench. He's done his BA, LLB, and he's also pursued his masters. He's an independent practitioner. And prior to going independent, he earlier was associated with the esteemed chambers of Mr. Samir Jain, who is now Honorable Judge of Rajasthan High Court. And he was earlier associated with Messrs. O.P. Agarwal and Company, Chartered Accountants. And he has regular appearances before Honorable Rajasthan High Court, District Sessions Court, NCLT, ITAT, Consumer Fora, special courts such as CBI, NDPS, etc. Now, thank you so much, sir, for taking out time. It's a working day and totally understand. Today happens to be a holiday, so I stand corrected there. And now you'll be discussing legal aspects of direct taxation. So the stage is set, the floor is all yours. Over to you.
Thank you, Jay. Thank you very much for having me here and for a wonderful introduction. And it's, I must appreciate, it's a very nice platform and a very nice topic that you have chosen. So regarding the aspect of direct taxation, I believe that much aspects of this finance bill have already been taken care of by our friend Mr. Vyas, and wonderfully so. And since I'll also be dealing with the same aspect of direct taxation, so I'll try to be as brief as possible and to avoid repetition. And still, if it inadvertently happens, so I'll seek a forgiveness for that. So I'll start with the provision for updated return, as was the last topic discussed by Mr. Vyas. By this budget, a new provision has been introduced to allow the taxpayers to update their past returns and include an omitted income by payment of additional tax. Earlier, there was only the provision of filing belated return, which could be filed till the end of the assessment year. But now a period of 2 years is given to the assessees, wherein they can include their additional income, which was earlier omitted for whatever reason. Now, regarding the payment of tax on this additional income, I do agree with Mr. Vyas that it is a little bit harsh because of the high rates, because you have to pay additional tax at the rate of 25% if the return is filed within a period of 12 months. And it is 50% in case where the return is filed after 12 months, but before 24 months. So the rates of tax are a little bit higher. And also you cannot use this provision for your own benefit, and it is only for offering additional income. You cannot claim any loss in this, and you also cannot claim any refund, and no benefit you can see, only for offering additional income and payment of additional tax. Now I'll move it over to the second provision which I need to discuss. It is section 80IC. The existing section 80IC was introduced. It provides deduction at the rate of 100% of the profits derived from eligible business by an eligible startup. This was to provide exemption to the startups for a period of 3 years starting from the year of incorporation, subject to certain conditions. Number one condition was that the startup should have a turnover below 100 crores. Number one. Number two is that there should be a certificate of eligible business from Interministerial Board of Certification. And number third, of course, is that it should be incorporated on or after 1st of April 2016, but before 1st of April 2022. Now, keeping in view the pandemic situation, which has caused delay in setting up of various startups, this situation has been dealt with in this budget. And the date of incorporation, the last date of incorporation of these startups has been extended to 31st March 2023. So this is a welcome step to give encouragement to these startups by extending the benefit of exemption to the startups, which earlier had to lapse on 1st April 2022, and it now extends to 31st of March 2023. Now, I move over to the next proposal, which has been made by reducing the rate of alternate minimum tax in respect of cooperative societies. As has already been informed by Mr. Vyas, that the rate has, in respect of cooperative societies, has been reduced to 15% by modifying Section 150 BC. Now, in respect of National Pension Scheme, the deduction of which is provided in section 80 CCD, there was a difference in respect of the central government employees and the state government employees. In respect of central government employees, the rate of deduction which was allowable to central government employees was 10%, sorry, 14%, and in case of state government employees, it was 10% only. So to bring parity between the central government employees and the state government employees, this limit of 10% in respect of state government employees is now increased to 14%. So it will give benefit to the state government employees, and they will get a deduction to the extent of 14% in respect of the contribution to National Pension Scheme. Now let me discuss certain provisions which have been amended or newly inserted in the Income Tax Act. Some of them are beneficial to the assessee. Some of them may be contentious and might be intended to nullify the judgments of some high courts and even the Supreme Court. And some of them are to make the taxation regime stringent. So first of these provisions is Section 14A. Section 14A, it of course provides for disallowance of claim of expenditure in respect of an income which is exempt from taxation. It provides that if you are earning an income which is exempt from taxation, you cannot simultaneously claim benefit of deduction of expenditure which is incurred to earn such tax exempt income. You cannot have benefits both ways. Firstly, of having exemption on the income, and secondly, by claiming deduction of the expenditure incurred for earning this tax exempt income. So this provision, it existed as such. Now an issue arose that suppose in a particular year, if there is no tax exempt income, but there is corresponding expenditure which has been incurred to earn such tax exempt income, and it has been claimed by the assessee. So can it be disallowed? Now this issue was decided by various honorable high courts, and more particularly Delhi High Court in the case of Caminvest India, Caminvest Limited, wherein the Honorable Court held that no disallowance under Section 14A can be made in a particular assessment year where there is no tax exempt income earned by the assessee. Now, they now by way of the proposed amendment, they have inserted an explanation stating that the disallowance can be made even in case when there is no tax exempt income in a particular assessment year, which directly nullifies the judgment of Honorable Delhi High Court, Bombay High Court, and other high courts which have taken the same view in line of the Delhi High Court. So apparently this amendment is contentious. It's going to result into various type of litigation, because this apparently has been given a retrospective effect. So it may happen that reassessment notices will be issued on the basis of this explanation. Now, moving on to section 37. Section 37 provides for deduction in respect of expenditure which you have incurred in earning income from business and profession. Explanation 1 of this section 37, it provides that if you have incurred an expenditure by doing an act which is an offense under any law for the time being in force in India, or if it is prohibited by any law for the time being in force in India, then that expenditure will not be allowed as a deduction and it will be disallowed. Now, so far, it was restricted only to the laws, enacted laws. We must say acts or statutes. And secondly, it must be forced in India. Now, what they have done is they have expanded the scope of this disallowance by expanding its scope beyond India. I mean, if an act is an offense outside India by virtue of any law which is in force outside India, then also the expenditure would be disallowed and it cannot be allowed for the purpose of computation of income under the head profits and gains of business and profession. And secondly, the law, which earlier used to be, we can understand as act, now it has been expanded to include rules, regulations, and even guidelines. So if you incur an expenditure which is in violation of not only an enacted statute, but also in violation of certain rules, regulations, or guidelines, then also the expenditure would be disallowed. Now, this has a direct impact on the pharmaceutical industries. Why? Because as we all know that pharmaceutical industries, they often provide benefits of travel, hospitality, and other perquisites to medical practitioners, which is prohibited not under any law, but there exists a regulation of 2002 which prohibit medical practitioners from taking such benefits from pharmaceutical companies. So by virtue of that prohibition, now the pharmaceutical companies will not be able to claim that expenditure which has been incurred in giving benefits to the medical practitioners. But now one question, however, remains unanswered as to what will happen to the freebies which are given by the pharmaceutical industries, pharmaceutical companies to the medical practitioners, doctors, etc. This question will, of course, be a matter of litigation once these provisions are enforced. Next is section 40. Section 40 has been amended. Why? Because it provides that no deduction shall be allowed in respect of tax paid by an assessee. There were judgments wherein it was held by the Honorable High Courts that tax shall not include cess and surcharge. But now to cover up that situation, they have amended it to clarify that the word tax shall, of course, include surcharge as well as cess. So no deduction now can be claimed in respect of cess and surcharge paid upon the tax. I would come over to section 68, but section 68 has already been dealt in detail. But however, I might add here that this is a good step towards making this provision stringent and bringing to tax the unaccounted money which is introduced in the books of account of an assessee in the form of loans and borrowings. At the same time, it might be a hardship for the assessees because now they will have to prove source of source, which might be a difficult task for the assessees, given the fact that the assessments are now to be conducted in the faceless manner. Now, proving source of source in faceless assessment proceedings will be a difficult task because because assessee might be required to produce the person from whom he has borrowed the money. So, production of that person in person and getting his statements recorded, and that too in a faceless assessment proceedings, these might lead to certain complications and difficulties for the assessees. Moving on to section 79A. This is a new provision which has been inserted by this finance bill, and it says that in case where search under section 132 or a survey under section 133A has been conducted and consequent thereto some undisclosed income was declared by the assessee, then you cannot claim set off of this undisclosed income against any kind of loss, whether brought forward or not. And you cannot also claim set off of this undisclosed income against any unabsorbed depreciation. Whatever undisclosed income has been found during the course of search or survey, that has to be taxed at the flat rate of 30%. Now, there have been amendments in section 144B. 144B, it provides for the mechanism developed for conducting faceless assessments. But during the course of time, various issues were felt. There were technical problems, and there were issues where assessees were not given personal hearing, and it amounted to violation of principles of natural justice, which of course resulted into a spate of litigations because the assessment orders passed without giving opportunity of hearing. They were being challenged before the high courts, saying that there is violation of principles of natural justice. And of course, high courts had quashed those assessments, saying that principles of natural justice have to be violated and they cannot be taken away by merely introducing a faceless scheme. So to tackle the situation, they have specifically inserted a clause in section 144B, which says that the assessee can ask for a personal hearing, and once it has been asked, it has to be mandatorily provided. So now it's a statutory requirement. Then moving on to section 158AB, as has already been discussed, it is to manage tax litigations and to avoid multiplicity of litigation and multiplicity of petitions on the same issue. It says that in case of an assessee for a particular assessment year, one question of law is involved. And that same question of law is involved either in the case of same assessee but for different assessment year, or in the case of another assessee for another assessment year. And it is pending consideration before jurisdictional high court or the Supreme Court. And the same issue has arisen in the case of the assessee for different assessment year in the order of Commissioner Appeals or ITT. So now the department will not blindly file an appeal against that order. Rather, they will wait for the decision on that question of law from the jurisdictional high court or the Supreme Court. Until then, filing of the appeal shall be deferred. And there is mechanism prescribed in section 158AB as to how that deferment shall take place and how they will manage to avoid the appeal getting time barred. So that has been done by making a provision that they shall file an application before High Court or the tribunal saying that the question of law is pending consideration before High Court or Supreme Court. So we shall file an appeal once we receive a decision in that case. So this will save the appeal from getting time barred. So this is certainly a welcome step, and it will avoid multiplicity of litigation on the same issue, and certainly beneficial to the assessee. Now, with regard to benefits and perquisite, section 194 is there, and it's a newly inserted provision, and it says that the persons who are responsible for providing any benefit or perquisites to any person, they shall ensure deduction of tax at the rate of 10% on the value or the aggregate value of the benefit or perquisites. Now, this, however, shall not apply in case where the aggregate value of the benefits or perquisites does not exceed 20,000 rupees. And in case where it is paid in kind, not in cash, then it is the responsibility of the person providing the benefits that he shall ensure that tax on this benefit or perquisite has been paid. Now, there comes section 206AB and 206CCA, which have been amended to make the provision with respect to non-filers of income tax returns more stringent. Section 206AB was inserted by virtue of Finance Act 2021 with respect to those persons who have not filed their income tax returns for 2 consecutive preceding assessment years. Now, it was provided that in respect of such persons, the rate of TDS shall be higher in case where rate is provided in the Act itself. Now, the rate will be twice as much as which was provided in the Act itself. Or if no rate is provided, then the applicable rate which is in force twice of that rate will be applicable in respect of these non-filers of ITR, or 5%, whichever of these three is higher. So higher rates of TDS is prescribed in respect of persons who have not filed their ITRs for the 2 consecutive assessment years. Now this the definition of these non-filers, or we can call defaulters. So in order to say a person as defaulter or non-filer, there was requirement that he should have not filed return for 2 consecutive assessment years. Now this has been done away with, and this 2 years period has been reduced to 1 year. So if a person has not filed his ITR just for the preceding assessment year, and the aggregate amount of TDS which was deducted in the preceding year was exceeding 50,000, then this provision shall apply, and higher rates of TDS shall also be shall have to be deducted in his case. So I believe, Jay, I have covered the most of the provisions which have been brought into effect by this budget, and now I'll hand over the stage to you.
Fantastic there. Thank you so much for your valuable insights, Mr. Javed. And on a lighter note, every time there's a new amendment or there's a new edition, and that results in curbing of multiplicity of proceedings, and that is always proving to be fatal for lawyers, because the more the litigation, the better it is for lawyers, even frivolous for that matter. And but on a very serious note, I think certain key points that you made, which are very relevant, is the fact that every now and then we see assessment orders be challenged before honorable jurisdictional high courts, and wherein there's a common ground, which is opportunity of hearing not given. We were not
Yes.
heard. And every now and then, constitutional courts need to intervene in matters that could have been easily decided by the officers below, which are empowered by statutes. So I think this is one key takeaway from this budget that you made. So we appreciate your presence. You took out time, and really means a lot. And so now, this was the direct taxation, moving and going ahead to a little more interesting field, a field that deals with the banks, the banking industry, and digital currency. And joining us today on the Virtual Amicus, well, he's again an All India ranker, former 35, qualified chartered accountancy back in 2012. And he's a chartered accountant by profession as well as an insolvency professional. He worked with PricewaterhouseCoopers, the audit department, for 4 years as article associate, and later on joined his own family business, and is now currently looking after the operations of Malviya Urban Cooperative Bank based in Jaipur. So today we are joined by Mr. Udit Agarwal. Thank you so much, Mr. Agarwal, for taking out time for doing this session on the Virtual Amicus. And Mr. Agarwal will be dealing with, as I mentioned, interesting, relatively, comparatively more interesting topics, such as the introduction of Digital Rupee in financial year of 2023, which the RBI is set to introduce. He'll be also talking about the banking industry and also cryptocurrencies. So, sir, the stage is set. The floor is all yours. Over to you.
Thank you so much, Jay. It's my pleasure to be on your show. I think me and Sachin are amongst the first CAs to be on your show other than lawyers. So very happy to be here and very proud of your success. So as you told that RBI is set to introduce the digital rupee this year. So this is very different from cryptos. This is called central bank digital currency. It is as equivalent to the money lying in your bank account or in your pocket. So what happens, this is based on blockchain rather than the current centralized banking technology. Blockchain is different from centralized banking in a manner that in blockchain, you can see the history of transaction. Like if you RBI allots you some money, some digital currency, so there'll be a complete open transaction network showing that rupees 100 have been transferred by RBI to Jay. Say Jay transferred that rupees to me, then it will be open forum, it will be open there, that Jay has given me 100 rupees, rather than you sending me rupees 100 through your account via IMPS or UPI or any other mode. So that's the difference between blockchain concept and the centralized banking concept. This rupee will be as equal to the money in bank account, and it is not volatile as cryptos. Like cryptos keep on changing rates 5%, 10% daily these days, and there is no mining and all. The good part is that the bank RBI is saving on the printing of notes and issuing digital currency. So very good and welcome step. It is very clear that they are not welcoming cryptos, they are welcoming digital currency. Then very good other important point is that the finance minister has spoken about is that extending of emergency credit line on hospitality and related sectors. Because of COVID, obviously hospitality and travel industry is the worst hit. So they have allowed additional 20% funding on the existing borrowings, which allow them to revive their businesses. So all banks, NBFCs have a very important credit line open, and that too guaranteed by the government itself. Another welcome step is that they have allowed insurance of loans to MSME, to be precise, micro and small. There's this trust, Credit Guarantee Fund Trust of Micro and Small Enterprises, which is operated by the government. So where the borrower can insure himself so that they don't face any hardships in case of non-repayment of the loan. And it is also useful for the banks because they can guarantee their funding. So they are very helpful because it allows them to lend them money under a government guarantee scheme. Another welcome step is like digitalization. So scheduled commercial banks are ready to set up 75 digital banking units in different small districts, which will allow again digitalization of banking sector, online operation of banking. Like UPI has expanded a lot. I think it is the highest digital transactions we are having each and every month going forward. In IBC, insolvency and bankruptcy, there have been amendments made with respect to cross-border insolvency. Cross-border insolvency is like in case of Jet Airways, there was a case where the flight was held in Netherlands because of a dispute over there for pendencies of dues. So now they have incorporated in the act itself that cross-border insolvency will be dealt in India with respect to Indian companies only. Also, with respect to cryptos as has been mentioned by Mr. Vyas already, that it will be taxed at 30%. So that doesn't make it legal in any form. Cryptos has been a complete avoid by government, and they are going forward with that route itself. And with respect to direct tax, I think my friends have discussed already. One point which I have a different view from both of them is that with respect to the updated return, it's a welcome step because the assessee can pay 75% tax effectively, the tax and interest and higher tax, and declare some income. Otherwise, he would have faced some search or seizure. It would have gone as high as 110, 20% plus penalty itself. So he becomes free at declaring it at 75%. So that are the changes and the amendments from my side with respect to banking sector.
Very well. And anything that you wish to say on crypto? Do you think that this digital rupee will be successful as it?
Yes, definitely. Digital rupee will be successful because it is not volatile at all. It is as same as 1 rupee in your pocket is 1 rupee in digital rupee. So no, the volatility saves it from all the hardships. Like you have heard of investors losing money in crypto, investing so much money, it fell down 10%, 20%, 30%. We have heard even some currencies reduced to half, zero. There have been fraudulent transactions. So this is governed by the government itself, plus it works on the blockchain concept. So the blockchain concept will lead to similarities with Bitcoin, Ethereum, all other currencies, and being governed by the RBI itself leads it to very simple and clear mechanism. Also, there is accountability, like they know who has transferred money to whom. As of now in Bitcoin, you don't know whether you are receiving it from any terrorist or a wrong person or black money or whatever.
So I think to sum it all up, any such introduction or any such digital currency that gets any kind of statutory or government recognition or backing, makes it investment friendly. The background check is done, and for sure that there is a statutory remedy available.
What a kind of investment actually. It's just like a money lying in your bank account, like net banking. It is equivalent to that. There is no investment in this. It's very clear. It's as good as your money lying in your bank account. Just that the concept is working on blockchain, which is similar to cryptos.
Very well. Thank you so much there for clarifying. That's a very important topic that you've discussed and that has always been in the line and that has always been hitting the headlines for now. So from crypto to banking to, customs and GST, we now welcome our next amicus for today's session. Well, for the first time on the virtual amicus, we have a speaker who will be putting in his second appearance on the virtual amicus. and he did the fourth episode for us on introduction to GST and removing the cascading effect. That was episode number 4. And today on this 95th episode, we are again joined by Mr. Daksh Pareek. And just to give you all a brief introduction about our amicus for today's session, Mr. Pareek is a practicing advocate. He's dealing in corporate and commercial litigations. He has appeared in various tribunals across India, Honorable Assam High Court and the Honorable Supreme Court of India. And he has various reported judgments that he argued himself in the area of direct taxation as well as indirect taxation. And he has been giving lectures frequently at institutes of company secretaries Jaipur chapter on a regular basis. So thank you so much, Mr. Pareek. Welcome you once again on the virtual amicus. And the sages said the floor is all yours. Over to you.
Thank you, Jay. And I'm glad to be a part of this show. And importantly, on such an important discussion of the budget. And I'm more overwhelmed to be a part of this show for the second time. So thank you for having me here. Now, when we speak about budget 2022, as rightly pointed out by Mr. Sachin, that there has been no change in the tax slab, which I personally believe that the government should have looked into the changes in tax slab, because as far as the common man is concerned, so when we say that your expenses are increased, supposedly corresponding to the inflation. Now, inflation is supposedly we take 6 to 7%. Your expenses goes up by 6 to 7%, and your tax slab are same. So this would amount your income to be taxed at higher rate, which I personally believe that there should have been a changes in tax slab and rebate should have been provided. Now, coming to the constitutional aspect of the budget, Article 266 of the Constitution of India defines the consolidated financial statement. Now, this Consolidated Fund of India is designed to account for the all receipts and expenditures made by the government. Now, in order to draw the fund from the Consolidated Fund of India, the Parliament assent is required. Now, this Parliament assent is required as per the procedures laid down under Article 112 to 117 of the Constitution of India. Ironically, I must say that this budget, the term budget, is nowhere defined in the Constitution of India. So, Article 112 speaks about laying down the annual financial statements. Now, this annual financial statement is commonly called as budget. The constitutional mandate for the parliament assent in order to draw money from the consolidated fund of India has been provided in Article 114. 114.1 categorically speaks that bill has to be introduced in the parliament. The bill, which is properly, which more popularly known as appropriation bill, has to pass in accordance with the Article 114.3 in order to draw money from the Consolidated Fund of India. So this is basically the constitutional mandate and procedure to provide how the budget is laid down and how the money is appropriated from the Consolidated Fund of India. Now, coming to the changes in the Customs Act as well as GST Act. Now, the changes in Customs Act is very interesting, and this amendment has checkered history, and the battle of judiciary and legislative continues for yet another 10 years. Now, this edifice of the amendment was laid down by the Honorable Supreme Court way back in 2011 by the judgment of Sayyid Ali, wherein the Honorable Supreme Court categorically said that the DRI officers are not the proper officer under the Customs Act, and they are not authorized to issue the show cause notices. Now, to overcome this judgment, the government in 2011 itself issued a notification. Now, this notification issued brought a new section in section 28 of the Customs Act, whereby the power to the DRI officers was vested to issue the show cause notices. Now, this amendment was again challenged, and interestingly, the Honorable Delhi High Court, in the case of Mangli Impacts, has laid down that even after the amendment, the officers of DRI has no power to issue the show cause notice under the Customs Act. Now, this Mangli Impacts is currently pending before the Honorable Supreme Court, and the judgment is yet awaited. But the Honorable Supreme Court in 2021, in the case of Canon India, has laid down the similar parallel lines that the DRI officers are not the proper officers, and the interestment of the powers under Section 6 are required to be made in order to vest with the powers to issue the show cause notice. Now, to curb down this legislative judiciary is act and the judgment of Supreme Court, the amendment has been sought to be made in section 234, section 5, section 3, section 28, and section 110A of the Customs Act, mostly to give the powers to the DRI officer. Now, I personally believe that DRI is such a huge branch of the indirect taxation, and I personally believe that the amendment ought to have come to to give the powers to the DRI officers. Now, coming to the GST, I would like to bring to the this consideration that the Honorable Finance Minister has announced that there has been a exorbitant collection, and I would state that the revenue collection from GST is 1,38,394 crore. It is a huge collection and huge GST revenue since the inception of the GST. Now, the changes in the GST law are more procedural than the substantial changes. The consequence of non-filing has been made more stringent. Similarly, the availment of ITC has been restricted. Now, this was necessary to be done because this GST law is entirely based on the portal. Though the GST law provides for matching concept, now the matching concept means that the ITC of the recipient of inward supply to be matched with the corresponding outward supply of the supplier. But this is all based on the returns. This is all based on the form. Where is the actual supply? Now there is no actual supply, unlike the central excise or the erstwhile indirect tax legislation. Now, when we speak about the indirect taxes, erstwhile indirect tax legislation, the input tax credit was made available only when there was actual movement of goods outside from the factory. Now, then only the ITC was made available, or we could have utilized the ITC. But this is not the concept in GST. So, as soon as we file the return and the corresponding returns are filed by the buyer or supplier, we are made entitled for the ITC. Now, I personally believe that these stringent provisions for restriction of the ITC ought to have been brought into the force by the amendment, because we are seeing a lot of cases where the GST department is coming up with the wrongful availment of ITC and issuance of fake bill. Now, in order to curb down this issuance of fake bill and the wrongful amendment of ITC, the law has been rightly amended by the budget 2022. Now, another major area in the GST is refund. Now, it is very welcome move that this explicit refund provision for utilization of ITC has been provided in Section 54. Now, interestingly, Section 54 provides for the utilization of the credit or utilization of the refund or the claim which is lying in my electronic cash ledger, which was not earlier. Now they have brought the provision for under Section 54, the explicit provision. Now the cancellation powers has also been widened under the GST regime, and Section 29 of the CGST has been amended, and the cancellation of the GST powers has been given to the officer in case there has been continuous non-filing of return in case of the taxpayer, normal taxpayer or composition taxpayer. So majorly, in my opinion, that the amendment and the bill has been deftly designed to safeguard as far as the government qua the indirect taxes legislation is concerned, because indirect tax legislation forms a major contribution of the government of India. So now we cannot, it would be premature, very premature to say whether the budget is good or bad, because it lays down the concept of Amrit Kal. So we have to wait for another 25 years to see that how India shapes for the new budget. So this would be my comment on the indirect taxes legislation.
Very well. Thank you so much, Mr. Daksh Pareek, for your valuable insights on the indirect taxation aspects. And the floor is all open. Anybody who wishes to say anything before we wrap this up, anything that you think is important for the viewers to know that we've missed out inadvertently on any aspect, on any topic, on any issue, as parting words? Very well. I think we are at peace with
I
whatever.
guess we have covered all the topics exhaustively. So
One very
there's
good
barely
point I
anything
would
left.
like to make here is that, which Sachin clarified, that if we trade cryptos currently before the amendment of budget, that would still be taxable, because there are many people of the view that I will transfer all my crypto holdings before 31st March to rupee and be saved from
Oh.
tax. But that is not true at all. So that is a very good insight and should be brought in knowledge of everybody.
Extremely important point there made by Mr. Udit Agarwal. I think we've delved into almost everything from indirect taxation to direct taxation to banking industry to crypto to digital currencies to I think we've more or less covered everything. It has to be pretty much one of the most comprehensive presentations on YouTube on budget 2022, and I'm sure all our viewers will immensely benefit from this. So thank you so much, Mr. Daksh, Mr. Udit, Mr. Sachin, and Mr. Javed for taking out time for doing the session Decoding Union Budget 2022, the hits and the misses, for highlighting and pointing out all the key points from amendments to judgments to all the regulations and governing rules, from statutes to the key amendments that have taken place. Really means to me and my entire team, and I'm sure this will immensely benefit everybody. To all the viewers who are watching, our email is mentioned on the channel. Feel free to write to us in case of any of the queries with respect to fundamentals, concepts, or anything that you wish, any query that you have that you want us to address to. You can directly write to all our speakers, or you can very well write to us, and we'll be more than happy to forward the same to our keynote speakers for today's session. So there you go, two distinguished lawyers, two brilliant chartered accountants, decoding the budget 2022 for us. Thank you so much, everybody. Once again, it's goodbye for now.
Uh, Thank you, Jay.
Jay.
Thank you
Thank
so
you.
much for
Thank you,
having
Jay.
us. It was wonderful to be on this panel. Thank you. Thank you for
Wonderful
taking out the
session.
time to do
Okay.
this.
Bye bye.
Bye bye.
Bye.
Bye everyone.